Again, I'd like to thank you for joining us for today's webinar, USDA's Section 538 Guaranteed Program, Part 2, Preservation and Rehabilitation of Section 515 Rental Housing. I'd like to welcome our presenters today. Joining us on the call from USDA Rural Development, we have Martha Hanson, Edgar Morales, and Melody Taylor. Martha started her career with USDA in Pennsylvania. She worked in the district office as well as the state office before joining the national office staff in 2014. She's very familiar with all aspects of multifamily, from loan making to loan servicing to transfers. Edgar Morales serves as part of the headquarters team in the Multifamily Guarantee Loan Division at USDA Rural Development as well. He previously served as California's Program Coordinator and Underwriter for Rural Development Section 538 Guarantee Program, where he was directly responsible for growing California's guaranteed loan program into the #1 program nationwide. And last but not least, we also have Melody Taylor Ward, who is a finance and loan analyst for RD. Melody began her federal career in 1986 with Farmers Home Administration and has worked in many programs offered throughout rural development. Melody has worked in the multifamily housing sector for the past 27 years and currently works for the Guarantee Loan Division out of Washington, D.C. Prior to working in Washington, Melody worked in the Ohio Multifamily Housing Staff Office, where she was primarily responsible for the Section 538 program. And so at this point, I would like to turn the presentation over to Melody.
Good afternoon, good morning, depending on where you're located. I would like to say thank you to HAC for having me on today. My presentation is going to cover the Section 538 Guarantee Program. We're going to do a brief overview of the program because we may have some participants on the line today that weren't present at last week's part 1 of the webinar. So the Section 538 Guaranteed Rural Rental Housing Program, what are we? We are a guaranteed program. The purpose of the Section 538 program is to increase the supply of affordable rural rental housing in eligible rural areas. The program works with qualified private sector lenders to provide financing to qualified borrowers, and again to increase the supply of affordable rental housing for low and moderate income individuals. Our program differs from the Section 515 program in that the 538 program does focus on partnerships between USDA and qualified lenders, and whereas the 515 loans are directly funded from USDA to profit, nonprofit, and for-profit housing developers. We are a loan guarantee program. When the program was originally designed, it was anticipated that we would serve low to moderate income tenants, so we can go up to 115% of area median income. The average rent that is allowed at the properties is 30% of 100% of AMI. We do offer loan guarantees for new construction, for acquisition with rehabilitation, or for rehabilitation for stay-in owners. So they do not have to be Section 515 properties to qualify for rehabilitation. We will guarantee loans made by private USDA approved lenders in eligible rural areas, and it is up to 90% loan of the loan is guaranteed. Lenders who are interested in becoming approved in the program can reach out to Tammy Daniels of our headquarters staff, and I have provided her contact information at the end of the presentation. We do offer 3 types of loan guarantee products: an option 1, which is a perm-only guarantee, an option 2, which is a construction perm, and an option 3, which is a continuous perm. The option 3 has currently a 50% loan-to-value limit on it, so we are looking to hopefully maybe change that in the future, but that is the limit as of now. Eligible rural areas can be found at the link provided in the presentation that you're seeing on your screen. So again, it has to be an eligible rural area to be qualified. There is no loan size restriction or cap. However, any loans that are greater than $5 million will have to come into headquarters for review. So the state offices are currently reviewing loans except for those that are larger than $5 million. The program allows for, again, permanent only, construction perm, and rehab without acquisition. The rehabs, you have to have a minimum of $6,500 per unit to qualify. USDA's lien must be in first position. We do charge some fees in the program. There is an initial guarantee fee that is equal to 1% of the guaranteed portion of the loan. And then there is also an annual fee that is 0.5% and based on the principal balance of the loan. And again, the rent is capped at 30% of 115% of area median income. What are the benefits for developers to use the Section 538 program? Again, the loans can be used for acquisition rehab for staying owners or new construction. There is a maximum 90% loan to value for a for-profit borrower and 97% for a nonprofit borrower. The maximum loan to cost is 90%, as I mentioned earlier. There is a minimum of a 115 debt service coverage on all serviceable debt. The terms minimum of 25 years and a maximum of 40 years. So you could have a 25-year term with a 25-year amortization, or you could do a 25 with a 40-year amortization. We do not set the interest rate in the program. The interest rates are negotiated between the borrower and the lender, but they do have to be fixed over the life of the loan. The program does allow for conversion to permanent at certificate of occupancy with the funding of a 2% reserve that is used to cover operating expenses and debt service during lease-up, and that is 2% of the total development cost. We also refer to this as our 90-90 reserve if you're familiar with our handbook. Another benefit for developers is there's no Davis-Bacon requirement, and the Section 538 loans do qualify for CRA credits. Okay, Section 538 guaranteed funding. So how does the Section 538 funding work? We do publish a notice of solicitation or notice of funding availability in the Federal Register, which announces what our program limits are and deadlines. The current notice is open through December 31st of 2021. Historically, our authority annually has averaged $150 million. In 2017 fiscal year, we did obligate $177 million, and we are on target to either meet or exceed that for fiscal year 2018. Our program is budget neutral, and for fiscal year 2018, we do have an authority level of $230 million. Please keep in mind that this program is lender-driven, so the more lenders that we have involved in the program, the better chance we have of increasing our authority level. I noticed that somebody indicated that I'm breaking up a little. Has that gotten any better? Fred, if you could maybe type in yes or no, I would appreciate that.
Yeah,
other benefits. Okay, thank you. Other benefits for lenders, again, 90%, they're up to a 90% guarantee. The lender does underwrite the loan. 100% of the loan can be sold. Again, they do qualify for CRA credit. The lenders can either sell or hold the servicing, and the lender would retain the servicing fee. Who are the Section 538 lenders? Eligibility could be banks, mortgage companies, housing finance agencies, real estate investment trusts. I also want to mention that typical Section 538 loan funding conduits can be Fannie Mae, HFAs, Ginnie Mae, portfolio loans. Lenders who apply to be eligible in the Section 538 program and are approved will remain eligible until they close their first loan in the program, and then they are determined approved at that point. Do we have any questions up until this point? And hopefully you're hearing me better.
Melody, I don't see any questions at this point, but do we want to go ahead and do that really quick poll to find out who we have on the call?
Sure, that'd be great. Thank you.
All right, so if you guys would just focus your attention on the poll, just really quick, want to know what is your role? Are you a developer, owner, part of management, entity, a lender, or state agency or other? All right, looks like there's a lot of participants here that are from either state, government, or FHA agency.
Great.
Still got some votes coming in. All right, so Melody, looks like you've got about 56% of the participants from either state, FHA, or other government agency, and you've also got quite a few developers on the line here today. So no questions at this point. I will go ahead and end this poll.
Okay.
Yeah.
Thank you.
Thank you. Okay, so Section 538, construction perm versus perm only. Okay, so a perm only is an option 1. Construction perms are either option 2s or option 3s. For a construction perm, funds are drawn down as construction or as the rehab or construction is completed, so it doesn't start off as a 90% guarantee. Interest-only debt service during construction is available. The loan will typically convert to an amortizing perm loan at certificate of occupancy. For perm only, 538, the loan closes and is fully disbursed at 90/90, or if a lease-up reserve is posted, as I mentioned earlier, a 2% reserve can be posted in lieu of reaching the 90% occupancy for 90 days. The level monthly principal and interest debt service, the rate locks at conversion to perm. There is a forward rate lock available for addition rate spread. That would be, you would discuss that with the lender that you're using for the transaction. Preservation using Section 538, and I know that Martha's going to get into this a little more down the line in the presentation. Preservation using Section 538 guarantees gap rehab financing and limited equity payments. So it wasn't anticipated when the program was designed that we would be used for gap financing, but since most of our transactions fall in line with low-income housing tax credits, that seems to be more and more what the Section 538 program is being used for. It also is being used more and more for Section 515 rehabilitation, but keep in mind it does not have to be a Section 515 property to qualify for rehabilitation. Very few owners have elected to simply pay off the Section 515 loan. However, in some instances, the Section 515 debt some of the debt can be paid off. The Section 515 loan must subordinate to the new 538 loan. Again, most of the transactions include some type of secondary financing, such as home funds, Federal Home Loan Bank, trust funds, etc. Remember that the minimum rehab is $6,500 per unit, and USDA will require a CNA to determine the scope of work. We do have a Section 538, 515 unnumbered letter that was published in November of 2017, and we call this our matrix. This is just a sample of what the matrix looks like, but what it is designed to do is to help understand specific program requirements when using 538 and 515 together. Currently, there are 28 different program requirements that are addressed in this matrix that was published in 2017, and it covers things that you see on the screen. It also covers items such as lease-up reserves, use restrictions, replacement reserves, etc. The unnumbered letter is available on Rural Development's website. Right now, as part of the team and headquarters for the Guaranteed Loan Division, there are 6 of us, and their contact information is on your screen and provided in the presentation. So if you ever have any questions regarding the Section 538 program, please feel free to reach out to one of us.
Perfect.
And Edgar, I shall turn it over to you.
All right. Thank you.
Edgar? Hey, Edgar,
Yes.
before we start, we've got a few questions that are holding in the queue. Do you want to go ahead and try and adjust those questions before we move along?
Absolutely.
Right. Okay, perfect. We have a question from Wes Cochran. Can you discuss equity payment on acquisition? My understanding is the loan does not fund it.
He's asking, Wes, you're asking what the flow of equity or payment into the transaction is. I'm not sure exactly what you're asking.
He's typing to provide more guidance now.
Okay.
So yeah. Let's see. All right. So Mr. Cochran will give you maybe another someone buying existing multifamily housing.
Okay. So
Right.
someone buying existing, well, if it really is going to depend on, and Melody, you can chime in on this anytime, but if somebody is doing an acquisition, we have different options. We have option 1, we have option 2, and option 3 of the program. Option 1 is going to be a perm loan. So the perm loan usually does not come into play on the preservation deals because they're using our proceeds for the construction normally during a revitalization or rehab type transaction. Usually an option 3 is used and the lender will then draw down as needed. We do not, from the agency point, control those drawdowns. It is the lender's responsibility to control those drawdowns as far as the proceeds going in for the process of rehabilitation. And that will go under an option 3. So option 3 would be what is mostly being used when there is a major rehab transaction if we're going to be involved in the actual construction or the rehab work. If we're just coming in and taking out a construction loan or a bridge loan, then that would be under option 1.
Okay, and so we've got 2 additional questions, or Mr. Cochran's provide a little bit more clarification, and then one additional question. But we're gonna
Okay.
do these 2 questions. So, can the new loan be used for equity and rehab?
Can the new loan be used for equity and rehab? When you say equity, like equity paid to the seller, that is allowed if it's part of a transaction that has, typically if it's we're doing a preservation of a 515, there will be a pre-approved equity amount, a pre-approved equity distribution amount to the seller as part of the transaction. The loan proceeds from the 538 can be used for the acquisition cost and to pay out equity.
Okay, so we're going to ask one additional question before we move along, and then all the others that are coming in, we'll save those to the end. But
Perfect.
The question from Aaron wants to know, does 100% of the units in a multifamily development have to be at 30% of 115% of area median income for rent?
No, so that's again, the neat feature of the program is you can do a mixed income project. You can do mixed rents. So if you want to, we're kind of the big umbrella. So 30% of 115% of area median, that's usually the largest income capacity or that we are allowed under the program. Typically, if there's other sources of funds like home funds or other funds that restrict the rents down to maybe 30 and 40% of AMI, that's typically the type of project that we have. Over 90% of the projects that we do have LIHTC on there. So typically our projects are underwritten at less than 50% of area median income. But you can have a portion at 20 to 30% of AMI, and then another portion of 30 to 40, and another portion, going on up into 80% of AMI and on up, as long as the project average does not exceed 100% of area median income. Even though we allow some rents to be at 30 of 115% of area median, the overall project cannot average more than 100% of area median income. I hope that wasn't too much, but the short answer to that was yes. Meaning no,
correct.
They do not have to. Yeah.
Right, correct, Edgar. So the average rent has to be 30% of 100% of AMI. That's the average rent if it's a standalone 538.
Correct. Okay, so let's just move on real quickly in the interest of time, and then we are going to get to the rest of the questions. So we've heard from last week and from the overview that Melody gave us on the 538. We pretty much have a good basic understanding of what we can and cannot do with the Section 538. But for the purposes of today's webinar, we're looking at things a little bit closer, how and what kind of role the Section 538 has played towards the preservation of 515 projects. Looking at it, kind of putting everything in perspective of the program, of the two programs together. We gave a description in separating the two programs. One is a direct program and one is a guarantee program. Some of the challenges that we've seen in preserving the Section 515 project with the 538 and other sources of funds is that many of our projects are older projects. They need a lot of work, and there's a lot of things that sometimes there's not sufficient sources in the deal to really make the deal work. Early program guidelines and regulations really didn't anticipate, bringing in private capital. So we've sometimes run into some or historically over the last few years had run into some issues as to meshing many of the other sources, especially when we're working with other state and local municipalities that are bringing in other sources of funds into the transaction. We in the early days, we used to have issues with subordination, getting past those things. Those were some of the challenges that we were facing when we were using private capital or other sources of capital when we're preserving the Section 538 projects. Again, we're talking about cost. Many of them have ADA UFAS compliance issues which need to be addressed. So the 538 plays a role in being able to bring additional proceeds to cover many of those type of costs. Rent structures, again, on many of our 515 projects have low to very low rent structures, therefore affecting values which limit the availability of equity, which also limit the ability to bring on more debt. So, Martha's going to be talking about some of the restructuring tools that are currently available that are going to help us get past that those hurdles. A lot of projects, depending on where you are in the states, some of the Midwest, East Coast projects tend to be a little bit smaller. They tend not to be as competitive when they're going into a 9% tax credit set-aside competition. And as we know, many of our QAPs have moved the bar a little bit where, they're giving more points to new construction projects versus preservation projects. Not that preservation is not that much of the same value as new construction, but they're looking to put new units on the market, and so therefore 9% tax credits are a lot more competitive when we're dealing with smaller projects. Not all of our 515 projects have rental assistance, and the ones that do have rental assistance, not all of them are 100% rental assistance. So that again has affected, and has been some of the challenges when we're trying to put new debt for preservation on the projects. Historically, prior to, I would say, the last few years where we've developed, where the direct program has really developed, new preservation tools and has really geared up their team to move these transactions along. Historically, it's been a lengthy process. It's been a challenge, and so many of us who've been involved in this preservation process with the 515 know that the process historically has taken a little bit longer than what is normally expected on preserving other like affordable housing transactions. So what are we doing? Those, I shared a little bit about the problems or the perceived hurdles. Some of the things that we're doing to move the preservation bar along is that many of the small projects are being pulled together in portfolio transactions, making it feasible for the projects to compete for a 9% award for maybe having multiple scattered site projects, one bond, and multiple Section 538 loans. The new use of the preservation tools, which Martha is going to be talking about here in the next few minutes, which would include, loan deferrals, the Preservation and Revitalization Demonstration Program known as the MPR. Melody touched a little bit on the underwriting matrix, and I put in there revisions ongoing because as we continue to work through the two regulations together and continue to work with local state housing agencies and other sources of funds that are available to be able to manage and preserve these projects.
Excuse me, Edgar.
Yeah.
Really quick, can you please check your connection? I'm getting a little bit of feedback from your line.
Okay. Is that better?
That does sound better. Let's try that.
Okay. All right. My apologies. And so, as I was saying, as the 515 and the 538 matrix is a great tool because when we're looking at the preservation of the programs, the lenders are looking at how are we underwriting these programs, and the lenders know that we're always underwriting to the most restrictive of the two guidelines. Although when we're dealing with issues of reserves, flow of funds, and other things that are important to that have individual identities of each program, the matrix allows you to look at that kind of like a cheat sheet and tell you who has precedence over the other in the program, which is the guideline you're moving, what kind of relief do I receive by using the two programs together. And so the matrix is a great tool. Ginnie Mae accepts loans coupled with 515. So when we have the two transactions, Ginnie Mae does not have the 70% loan to cost limitations when the two loans are combined. And so, that's a great benefit because, as you know, these two transactions become heavily leveraged, and in some cases, you're reaching that 90% or in excess of 90% loan to cost when you're combining the two programs. National office, which is we call headquarters, Unlike a few years ago, most of the underwriting was left to the field. The headquarters is available to assist your local state office in underwriting. Your local state offices are there to answer your questions when it comes to preserving, these transactions. We encourage all of you to start the communication early when we're dealing with preserving these transactions. What you don't want to do is go out and size a transaction. If you're a developer and a lender, you don't want to go out and size a transaction and then come to USDA and try to make it fit within the guidelines. That's usually not the best way to make things work, especially if you've made commitments to other parties in the transaction. And so what we do is we encourage you to involve us at the beginning and get us involved early in the conversation. The preservation, we talked about this last week. We talked a little bit about today. This is a private-public partnership. We're using private-public funds, not only federal, we're using local state, we're using many different types of programs. I think that these numbers, even though there's a lot of numbers on the screen here, this is just an example that we pulled so you can take a look at the example of the amount of dollars that we're actually leveraging with the 538 loan proceeds along with the 515. We've preserved over, just since we started collecting data on this in 2013, we preserved over 8,400 projects. Those are not units, those are projects with the combination of a 538 and a 515. So the program is working. They're working together. We've been able to leverage nearly 1.5 billion, just under 1.5 billion in total leverage with the use of about 201 million in 538 loans. And so since 2013, you're talking about roughly 5-6 year period. That's a lot of numbers. And so, we get a lot of calls, at times, and folks want to know, are these programs really working together? Well, the data tells us that it is. And we're finding more and more ways to be able to work through some of the older issues to move these projects along. And Martha's going to be sharing with you next, what those tools are and how we continue to work together to preserve the Section 515 projects. So Martha, I will turn this over to you and let the folks know of the good things going on in the direct side in assisting in preserving the 515 transactions.
Great, thanks Edgar. Well, welcome everyone. I'd say good morning and good afternoon. I'm on the East Coast, so it's afternoon for me, but I know some of you are on the West Coast, so it's good morning. Thanks again to HAC and the Guaranteed staff for including me in this presentation. So let's get started. So the Section 515 program, and it also includes the 514, 516 Farm Labor Housing Program, is the same as the Section 538, and that's to provide decent, safe, and sanitary housing. But as Melody said, we are a direct loan program, whereas 538 is a guaranteed program. Currently, our main focus is on the preservation of the existing Section 515 portfolio through the Multifamily Housing Preservation and Revitalization Program. And you'll hear us refer to that as the MPR program. The MPR program is a demonstration and is operated under a NOSA and available for both transfers and stay-in owners. The MPR program is used to renovate existing 515 and farm labor housing facilities. The MPR funds cannot be used to build new units, community rooms, add additional parking areas, playgrounds, laundry rooms, or offices. The only exception to this would be if these items are needed to meet accessibility requirements. There is no additional rental assistance available for this program. As Edgar said, a lot of the properties don't have 100% RA, but that doesn't mean that if a state has servicing RA that they could move into the project, that it couldn't be moved into it. The rents must continue to remain affordable for the tenants, and we don't want any tenants to be displaced as a result of any rent increase. So to ensure that this doesn't happen, we require that the owner establish a tenant protection account for any tenant that does not have subsidy. This account is funded from the owner's resources during the underwriting for a 2-year period. However, the owner would continue to subsidize these tenants after the initial 2-year period as long as they continue to live there and remained eligible, or until their income increases or they are given subsidy. Any property that is selected to participate in this program must execute a new 30-year restricted use provision anytime there's new third-party debt added. That means that the borrower and any successors must agree to use the housing for the purpose of housing eligible tenants as provided under Title V of the Housing Act of 1949.
Martha,
can you, it's hard to hear.
Yes, thank you.
Okay, sorry about that. Can you hear me now?
Yes.
Okay, sorry about that. Okay, properties selected under the NPR program can receive one or more of the available NPR tools, and we'll discuss those tools a little bit later on. RD determines which tools will be offered based on the availability of funds, impact on the tenants, and the physical needs of the property. However, in the 2017 NOSA, we did allow the applicant to apply specifically for either a 0% or a 1% deferred tool, but they were limited to only $15,000 per unit for each type, or a combined maximum of $30,000 per unit. If RD selects the tools, then there is no limit. In the cases where there's a transfer to a new owner and there's a proposed equity payout or an increased return to owner, we first underwrite the transaction as a transfer to meet the requirements of the transfer program, size the reserve, and set the new RTO. If there is deferral included as part of the initial transaction, we would also include the deferral in the initial underwriting, but no other tools. Once the reserve is sized and the RTO determined, then we will underwrite, including NPR tools. Okay, what are the NPR funding tools that are available? The first is a deferral of the existing agency debt for up to 20 years. Properties have a balloon payment at the end of the deferral. However, the agency will use all available servicing tools at that time to assure that the housing continues to provide affordable housing and that no tenants will be displaced. Another option is a 0% loan. This loan does require monthly payments. For a Section 515 loan, it's a 30-year term amortized over 50. So again, there would be a balloon payment at the end of the 30-year period, but we would do whatever possible to preserve the housing. The next option is a 1% deferred. We also refer to this sometimes as a soft second loan. The loan is deferred for the term of the longest loan on the property, which is typically 30 years, and accrues interest at the rate of 1%. And finally, we have grants available, but the grants are only available to nonprofit entities and are limited to the amount needed to cover upfront health and safety issues that are identified in a capital needs assessment. Other tools that can be used are low-income housing tax credits. This would include 4%, 9%, state tax credits, and occasionally and historical tax credits. You can also use a Section 515 subsequent loan or a 514, 516 labor housing subsequent loan if that's the type of deal you're working on. You can do third-party loans or grants such as Section 538 or home loans. The owners can contribute money out of their own pocket into the deal, but these are not considered loans, so keep that in mind. Or they can use project reserve funds. Types of deals. Typically, we see three types of deals. We have a simple deal, which is a stay-in owner with no change in ownership. We have complex, and this could be a transfer to new owners with or without consolidation, or a transaction requiring subordination agreement as the result of third-party funding. The third type is a portfolio. We see a lot more portfolios because, as Edgar said, a lot of the smaller deals can't do it on their own, but if they are combined into a portfolio, then they're more attractive as a transfer. This could include 2 or more projects with a stay-in owner or a transfer of 2 or more properties to one common purchaser. We've seen as many as 25, 26 properties in one portfolio. And all MPR tools are available to all 3 categories. As both Melody and Edgar said, the MPR program is accepted through a NOSA period. Currently, the 2017 NOSA closed on December 1st of 2017 for any transaction that was requesting MPR loan tools. However, this NOSA remains open through September 28, 2018 for any transactions requesting deferral only. That would be for a transfer or an existing or exiting property. Not a stay-in owner typically would not be eligible for a deferral only at this period. Any transactions submitted under the 2017 NOSA must be underwritten and approved by the agency by December 31st, 2018, or they will be considered withdrawn. This doesn't mean the transaction must be closed by that date. It just simply has to be approved by the agency. Okay. When a third-party lender, such as Section 538, is involved, it's important that each party know the other party's relationship, their responsibilities, and their requirements, as well as any subordination agreement that needs to be imposed. We need to know this stuff early on so that there's no surprises and everyone's aware of everyone's deadlines, their requirements, etc. RD can subordinate our lien position to a third-party lender or take a parity lien. Subordinations would require an intercreditor agreement or an MOU that defines each party's relationships, their responsibilities and requirements, as well as a subordination agreement that meets the agency requirements as outlined in Chapter 6 of Handbook 1 of 3560. The rents are established just as they would be for any other Section 514, 516 loan to meet the O&M debt service, reserve, and return to owner. The one difference between the 515 program and the 538 program, though, is that the annual guarantee fee is included in our O&M expenses on the 515 side and not in the debt service for the loan. The reserve accounts are established on a case-by-case basis to meet the needs of the property over the next 20 years. This includes meeting any third-party lender requirements. All debt put on the property must be within the agency's security value. And RD is the only place that you're going to hear the word security value. It's the actual prospective market value subject to restricted rents plus the total value of any applicable favorable financing such as the agency's interest credit or any below market finance loans. Non-amortizing and deferred loans are not included when considering the security value. So in a nutshell, that's our MPR and how we can use it in the 538 program to preserve our existing 515. Any questions?
Yes, we do have one question from Fred, and he wants to know, is there plenty of MPR funding or is it significantly oversubscribed?
Well, I happen to have those numbers here for you, Fred. Currently, our appropriations for the Section 515 is $35.9 million. Our 0% is at $80,000. Our soft second is at $20.7 million, and our MPR grants are at $40 million. Currently, we've got a long waiting list of projects that have already been approved waiting for funding. So the possibility of MPR tools probably won't be available until fiscal year 19. We do have some Section 515 funds that are available now, but our funding, as Fred said, is oversubscribed.
All right, we have a couple of polls that are being shown on the screen. If you would please take an opportunity, a really quick moment to go ahead and indicate your knowledge of the 515 as well as the 538 programs. That would be really helpful for us. Also, we've got another question that's come in. Could you please review the elements that determine security value once more?
Sure. It's the actual prospective market value subject to restricted rents plus the total value of any applicable favorable financing, such as the agency interest credit or any below market financed loans. And any new debt added to the property has to fit within that security value. New amortizing debt, I should say.
Yeah, and that's always a question, and that is a question that I think is more reason for lenders to reach out to RD to ensure that they are looking at these appraisals based on RD guidelines, and so that they need to include those calculations. Sometimes they're not including the right formula and giving it less value, which further restricts the ability of what the project can and cannot do. In some cases, it's overvalued. So that is another reason why you want to reach out, have your lender reach out. If you're a lender, reach out to RD. If you're a developer, have your lender reach out to RD so that they can go through that before you go down that road on the appraisal.
All right, and it looks like the polls are in. Most participants have some knowledge of both the Section 515 as well as 538 program. We do also have a good number of participants online who have no knowledge of each of those programs. Edgar, Martha, or Melody, do you want to address the polls at all?
No, well, I can just say that it's good. It looks like we have a good balance of both knowledge and the amount of transactions that have been done, which is both interesting and great to see, because we have many of our partners that know of the program, but some have not dabbled into too many transactions, and it looks like we've got a fairly experienced group. So yeah, no, that's good to see.
And just real quick, we did have a question from Susan McKittrick. She says, existing 515 AC rehab, option 2, not an option. I don't know if she's asking us if option 2 can be used for acquisition rehab of 515, or is she asking, is it being used? So I would answer you, Susan, to say it can be used. However, primarily, we are seeing the lenders using option 3 for the acquisition of the 515 properties. Option 2 isn't an option that we're seeing used very much lately in the program, because the lenders, they want that continuous guarantee. And so if you have a loan to cost of 50% or less, we're seeing the option 3 being utilized mostly. So I hope that addresses your question, Susan.
All right, I am going to go ahead and close out these two polls here. We do have some additional time before we get to the end of the webinar. Edgar, do you want to go ahead and proceed?
Sure. Do we have any more questions? I thought I saw somebody typing. Just want to make sure we...
Looks like we've got some fingers thinking out there.
Okay, all right, that's fine, that's fine. Okay, no, well, it looks like we don't have any more questions, but I just wanted to reiterate, some of the things that we covered, on the call. And one of the things is, as we know, these transactions can be fairly sophisticated. We've got a lot of moving parts. We've got a lot of different regulatory levels, both, we may be dealing with grants and loans from local HFAs. We may be dealing with direct loan money or direct loans, not necessarily new money, but we still have the regulatory regulatory agreements we need to address for the 515, and then we have the new 538. And so, these things, the more involved that you get RD, and I know you've heard this throughout the last couple of days, the more you get us involved early really will help to alleviate and vet some of the potential issues that you may have. And so I encourage for all of you, whether you have a solid transaction already, or you're in the conceptual stage, or you're a state agency that has some questions about what the underwriting process might be or what can be expected as far as timelines, we do encourage you to reach out to any of us at headquarters or your local state office, depending on what state you're at. You know, we are available for conceptual calls, and it really goes a long way to either get something going or shut it down before you go down the road too long on that. You know, other than we have funding available, we have lots of money, you know, when I say lots of money, we have lots of authority still left in the year for the 538. I think that Martha touched a little bit of what's going on in the 515. I'm not sure if you wanted to add anything in that respect, Martha. But other than that, that's basically what I have for comments. You know, again, Shantaria, I appreciate, you know, you and your team and HAC really continuing to be a platform for bringing these type of outreach opportunities so that we can reach out many of our members. For some of them, it's a revisit. For some of them, it's a new look at the program. And these are just a snapshot. You know, we obviously are not going to become experts in all of the programs, but at least it exposes us to some of the things. If we're contemplating getting involved, I encourage you again to reach out to us so that we can answer any questions. Martha or Melody, do you guys have any comments you'd like to add on that?
Edgar, before we end the call, we do have one final question that's just come in with regard to subordination agreements. Is there a one-shoe-fits-all agreement when 515 is subordinating to a new 538, or is this a negotiation between the lender and the agency dependent upon transaction parameters?
Okay, so, and I'm going to let the rest of the group chime in. So, from a 538 side, as long as there is not a standard 538 subordination agreement from the 538 side, depending if we're dealing with, and the reason is we may be dealing with other sources of funds in the deal, that can be negotiated with the agency as long as it has the necessary required language that is required for the 538. And again, that's one of the issues that, not an issue, but that's one of the items you want to vet ahead of time. If you've got other sources of funds like home funds or state housing funds coming into the deal, you know, give us a call. Let's vet that subordination agreement. That usually is not a problem like it used to be. You know, we understand that more restrictive language on the 538 side, we do allow the most restrictive use agreements to go senior to the 538 use agreement. The mortgage does have to be in first place, though. Melody or Martha, you want to chime in on that?
I'll chime in, Edgar. I wish it would be a one-size-fits-all subordination agreement. It would make our jobs easier, but as Edgar says, it's on a case-by-case basis. What you need to do is make sure that it agrees with the requirements in our Chapter 6. And if you have any questions, definitely get in touch with RD and have them vet it before you get too far down the road.
Hopefully that answered the question. Did we have any other questions?
Does not look like we have any additional questions come in. I think that's it. What I do want to say before we end the call today, want to thank Edgar as well as Martha and Melody for their participation and the wealth of information they've shared. Their contact information is going to be provided as part of the handouts from today's webinar. Also, please be on the lookout for an email which contains your certificate of participation as well as a link to an evaluation survey. Please complete that evaluation survey. That is the way that you let HAC know if we're bringing content to you that's relevant to your work. With that being said, I'd like to go ahead and thank everyone for your participation and time today and wish you a very well rest of your afternoon. Thank you.
Thank you.